There is the loss of confidence in the reserve currency, which drives people to see alternative storeholds of wealth. So, for example, when there's a debt issue, there are two ways of dealing with debt. There's hard money, traditionally backed by gold. And when that happened, then there was breakdowns in that monetary system, devaluation. So for example, classically, March 1933, Roosevelt, with the debt problem, was forced to go off the gold standard, printed a lot of money, devalued the dollar, and then it moved on. In 1971, we had the same. Nixon did the same thing, went off the gold standard, and devalued and so on. And the creation of a lot of debt and money means that money goes someplace else, and it traditionally, both of those cases, it went into stocks, gold, and other places. So money is always the holders of money, which are the holders of bonds. Bonds are a promise to receive money, a lot of money over a period of time. It's a very long money position. And when those become unattractive, such as now, let's say, you get zero interest rate or close to zero interest rate or even a negative interest rate, and there's a lot of creation of debt and a lot of printing of money, that drives that into other assets. They may not be another currency if there's not a good currency. They may be stocks, they may be gold, and they may be another currency. But it is that kind of time that we're in. So next year and the year after, no matter what, we're going to have large deficits. We are going to produce a lot of debt, and we will monetize that debt, and that debt will have a negative real return, and therefore people will borrow in it, will find it more advantageous to borrow in it than own it, and then they will move to other assets.